Eric Levenhagen here, guiding you down the true path to financial harmony. Last year, the New York Times published a story about Donald Trump's tax avoidance over the years. And I ended up hearing a collective groan from tax preparers in the tax community. They were expecting related questions from their, albeit less wealthy clients, right? So look, I'm not in here to get into the merits of the story or the tactics that were described there. There's enough debate about that on social media and other outlets, but reading through the article did make me think about legal tax strategies that you should be considering, even if you're not a billionaire, and even if you don't have this huge enterprise with several businesses and multiple properties all over the world. You have your own enterprise to protect, and we're going to talk about that today. So a key point here as well is that this just doesn't apply to, Donald Trump. We get this into these discussions a lot over the years in the past. I'm sure we will again in the future. Anytime a wealthy individual or corporation's tax news becomes public, whether it's releasing of tax return information, like is the case with a lot of presidents and presidential candidates, or if it's about, a large company like an Amazon or a Google of the world who's paying little to nothing in income taxes, we get into this discussion a lot. So it's worth taking a time and getting into the key difference here, which we want to drive home, which is this idea of tax avoidance versus tax evasion. So a lot of people don't realize this. Remember, tax avoidance is perfectly legal and allowable when it's done by the letter of the law. There are plenty of legal tax avoidance techniques that are available right in the black and white letters of the tax law. I mean, Supreme Court judges have even told us that it is within our rights to arrange our affairs to pay the least amount of tax possible. I'm paraphrasing there, of course, but just know that tax avoidance is okay when you follow the law. Tax evasion, on the other hand, is completely illegal, and evasion can take many forms, right? So underreporting income, which is purposefully removing income or not reporting it on your tax return in order to pay less tax. On the flip side of that, inflating deductions or even hiding money in a lot of times offshore accounts is discussed, and there's many other forms of evasion, right? The bottom line is that those are all an effort to misrepresent income to the IRS. So in short, we're not going to talk about that. Don't do it. So let's spend the rest of our time talking about some legal tax avoidance techniques, strategies that I help clients with all the time. I'd call these a little bit more advanced techniques. They're not necessarily the foundational tax items that everybody needs to address, but one of these things could really help you out, just being aware of them. The first one I want to talk about are business losses. And again, this kind of ties back to that article from last year in the New York Times. So look, of course, I hope your business is profitable. You don't have to worry about claiming losses in a business activity that you run. But just know, losses from a pass-through business are deductible against any other income. Generally, we call that ordinary income on your personal tax return. Of course, unless you're a C corporation, then there's some different rules there. Now, there are limitations depending on how you're taxed and how much you can actually deduct. But and prior law has put some limits on how big those losses could be in a given year. Now, that law has come and then was suspended for a bit, and now maybe back unless we have another tax law that extends it again. Always good to know if you have or facing a big business loss to the tune of $200,000 or $250,000 even in a single year, how much of that you'll be able to deduct. But beside that overall limit, knowing how much you can deduct overall, because of those other limitations that we're not going to get into detail here on. We just need to know that your business structure could affect that. Okay. All that said, there are plenty of ways to still show a profit and pay less taxes. So please, I implore you, don't spend more money just to save tax. Don't try and rack up a huge loss. A lot of times it's just not going to make a lot of sense, right? So let's talk about the next piece, which are real estate tax provisions. A common strategy in real estate is one that we call, or that is referred to as cost segregation. So look, the tax law is very generous to real estate investors and developers. but you don't have to be a mogul to use them, right? One provision you can use is the ability to depreciate certain parts of your property, whether you have a commercial property that perhaps you own your practice operates out of, you have other rental properties, commercial or personal, or residential rather. You can depreciate parts of those faster, get a bigger deduction. So every building is made up of structural components. Structural components of a commercial building or any building depreciate over 39 years. That's almost 4 decades for you to get the tax benefit, the deduction of the purchase price plus any major improvements. But your properties are not made up of just structural components, okay? There are other things in there that are removable, like floor coverings, furnishings, lighting, landscaping, so on and so on. And a lot of those elements depreciate, or you get to deduct them from 5 to 15 years instead of almost 4 decades. So that means bigger tax deductions for you now that can free up more cash for you to invest or use in current operations, or even increase your personal profit distributions. So if you own your office building or any other commercial or residential rental property, this is well worth looking into. Next is hiring your kids. Now, you don't have to pay your children an exorbitant amount of money in consulting fees or anything else to take advantage of this strategy. In fact, don't pay them consulting fees at all. Most small business owners should be looking and considering hiring their kids as a legitimate employee and put them on the payroll of their business. Of course, legitimate means they're, again, actually on the payroll, actually getting a paycheck for actual work that they are doing for your business. If you do it the right way, you can shift upwards of $12,000 per year or more per child that you have, per minor child that you have, to a lower tax bracket every single year. A lot of my clients have heard about this one when they first talked to us, but have never pulled the trigger and actually implemented it because they either, for a variety of reasons, either thought it was too good to be true or didn't know and weren't advised on the proper way to handle this. And so we deal with this one a lot. Again, referencing that article about Donald Trump, what about haircuts? So there was a big deal in the New York Times story about the president deducting haircuts and some other like personal stylists that he used for TV appearances, like his network TV broadcasts, right? So look, the tax law is always strict on expenses that could be either personal or business. This one's no different, right? Most of us don't have reality TV shows or another need for this really to make the cut. And yes, bad pun, I know, but to make the cut as a business deduction. So just because you have to appear well-groomed for your business, for your patients, does not make haircuts and styling a business deduction. So sorry about that, but there are plenty of other personal expenses that you should be looking at converting to business deductions. It's a section of our programs that we refer to as hidden tax deductions. So things like clothing, vehicles, cell phones, your home residence, just to name a few. The key here is there's a lot of rules for each one of those. Follow them or find somebody that knows the rules inside out and document everything well. And good tax strategist will help you. So remember, I've only discussed opportunities here, not the tactical steps of how to implement these strategies. That'd be a much longer video, and you're going to need a good tax strategist for that. Remember, if you take these ideas to your tax professional and they groan at you or just without looking at anything tell you that it can't be done, that's a clear sign that it may be time for a change and to get some more objective advice.